probably make a start.
Yeah, just a minute. All right. So welcome everyone. We'll wait for another 2 minutes and then we'll formally start with the event. And meanwhile, Jijo, make sure that everyone is muted and their videos are off. Jijo, are we live already?
Yes.
All right, cool. Okay, so I think, yeah, meanwhile you let others in, I'll just start and yeah, others can just keep joining. All right, so welcome everyone. Good morning, good afternoon, good evening, depending on your time zones. So this is the final TEG talk for this particular year, 2023. So we just started the Entrepreneurship Gyan initiative in this year itself, and this is the 8th talk in that series. And yeah, when we started, the idea, I've been repeating that idea for a while now. So already startup and entrepreneurship, special interest group of IT Bombay Alumni Association was there, which was taken care by Praveen Ji, Dr. Praveen Malla. And when I joined ITBA, obviously I was there. I knew a couple of things, but I know I decided to join this particular special interest group of startup and entrepreneurship. And then I told him that why don't we come up with some initiative where speakers like Amit, but also from academia, like we had Professor Venki, or the veteran entrepreneurs like Kamal Rekhi ji, and so that culture of entrepreneurship and innovation is developed, but also young entrepreneurs, budding entrepreneurs can connect and have their own wisdom, gyan, from these kind of sessions. And another thing which I've been mentioning for a while is that sooner or later we are trying to come up with a platform. So we are slowly going towards that. Still, we are building that profile of people who can be there on that platform to kind of create a good environment for young entrepreneurs, but also any entrepreneur for that matter. Obviously, IT Bombay Alumni, that's the target. That's what that's what IT Bombay Alumni Association focuses on, but also other entrepreneurs as well who would like to come and join these sessions. And that's why TEG Talk, for that matter, is open to everyone. And that's the idea, basically, to have that kind of forum where people can discuss entrepreneurship, people can have their understandings, people can collaborate, and there's an active WhatsApp group as well where people can share potential avenues either in entrepreneurship or research or in the practice world, depending on what might be the mutual interests. So that's what that's the basically idea in a couple of lines. So now I'll ask my co-host Venu to formally introduce the speaker, and then we can move on from there. To you, Venu. Just a moment.
Feels nostalgic at the same time to think that we just think back and feels like, oh, yesterday only the TEG had started. So great to see that we're ending the year on a fantastic note. So it's been an endeavor to bring diverse speakers And in one such initiative, we've been fortunate that we've sourced Mr. Amit Kumar as a speaker for today. So Amit brings in a diverse set of experiences. To call out his current, he is the co-founding partner at our venture funds, which is a SEBI registered AIF that invests in early stage sector agnostic startups in India. He has over 20 years of experience in VC, finance, business scalability, and he's a qualified chartered accountant. At our ventures, he spearheads the investment strategy, due diligence, and portfolio management, as well as advise and mentor entrepreneurs that they back. He's co-founded the maiden fund of 150 crore rupees in October 2022 after successfully raising funds from multiple investors. Previously, Amit was the CFO of a B2B e-commerce startup where he scaled up the business from 4 to 300 employees and raised about 22 million in funding. Amit has also extensive experience in management consulting, business strategy, risk management, audit, and system processes. His mission is to help startups and SMBs grow faster, smarter, and more sustainably. So definitely with the diverse set of experiences, Amitji, we are very curious and eager to learn a lot from you through this session today. So I'll pass on the stage to you. So over to you.
Thanks, Venu, so much for the lovely introduction. Obviously, I have not written it, so which is nice. And Vaibhav, thank you so much for inviting me for this session. Welcome, everybody. As Vaibhav said, good morning, good afternoon, good evening from people joining across the world, and this being live streamed is fantastic. We are coming to the end of the year, a year which from the startup investing perspective is not one of the best years that we have seen in the last 5 to 6 years as well. So 2023, if you see, overall investments have fallen pretty drastically. I should say the last year there were about $22 billion being invested into startups in India. And today we are talking about maybe $7.2, $7.3 billion invested as we speak into the startup ecosystem. And I don't think so. A lot of VCs are going to be working now in the next 10 to 11 days, people proceeding on holiday. So in a couple of days, there will be actually the last of the day working days that we are now witnessing. So it's been a tough year for investments for sure. But when it comes to early stage investing, the data is something else and the trend is something else. Early stage investing has always been our forte, and we have been investing in a lot of startups, not only from the fund, but also from the network. So our ventures is one of the prominent angel investing networks in the country, and we have invested in close to about 125 startups, more than 200 investments. So what we primarily look at is early stage investing, and I'm sure that there are a lot of people who are looking at early stage investing and also founders. So the topic that I've taken today or picked up today is not to do only with investing. So it is about as I said, the white, black, and gray of startup investing. And it's not just always black, it's not always white, but also there are pretty grays that we are typically talking about. So let us start with nicer things first. As we say, I've been a Toastmaster as well. So we follow the technique, which is say nice things, then we recommend certain things and close on a nicer note as well. So let's just begin with the whites, and I'm going to be dividing my whites into two parts, which are nicer things because white looks nice, although I'm wearing a black t-shirt. But when you mix black and white, it becomes gray. So that's the analogy I've typically picked up. So let's start with the whites, which are in favor of startup investing from the founder's perspective. And every element that I'm going to be picking up, then I move to the investor so that people understand what investments are into early stage companies and how they can circumvent certain things. So the first white that we have for the founders is, what is the advantage of early stage investing for a particular founder? Well, the biggest advantage is that they get the wings to fly. And that is why we call angels angel, not because they're actually angels, but they are angel investors. So they give you the ready-made money initially so that you can get the wings to fly. You are just learning at this point in time. And you must have gone back to your friends and family. You would have put a certain savings of yourself. But what you really need is someone to now help you get those fresh wings to start flying, or start now your business or the idea that you have typically conceptualized. So as a founder, the biggest white that you always have is at least you are getting money. A lot of people are not able to even raise funds. I think that is one of the most critical factors. If you are able to raise funds as a founder, one, you obviously get the funds to begin your journey as an entrepreneur in a more organized fashion. And I think the second biggest advantage that a founder has is that he is now getting external validation of sorts. There may be people who love you, their friends, family, and then say, okay, collectively, we are giving you 25, 50 lakhs because we just love Amit. He's a good person and we should give him that money. He's today or tomorrow is going to return that money. What about angel investors? Do you think that angel investors actually love you and they love your idea and they love your company? Well, I want to break the ice today in this case by saying that they don't love you at all, neither the business nor the money, nor the company that you're building. All they love is the money that they're investing and the returns they're going to make from it. I think that is the first thing that the founders should definitely keep in mind is, if the angel investor is nice to you, then make sure that you make him nicer by giving him returns that you have promised, by executing the business plan that you have typically gone ahead and presented to him. So that's the first white that we have, is that he gets the wings to fly and there is external validation from people whom he does not know and people who don't love him, his business or his company. I think when you have early stage investors, the other white that you have is that you are getting mentors and advisors. I think there are a lot of people who are angel investors per se in today's session, or maybe there are also growth and late stage investors. Obviously, I wouldn't know the profile of people who are joining today and attending. But yes, the founders have this beautiful white of getting mentors and advisors in form of angel investors. So angel investing is not just about going and investing money, but also investing your time sometimes, right? Because you don't want that the founder is putting the money not to so good use as you obviously want. So if they are not treading on a path which you think is correct, then they can appoint you as a mentor or an advisor as well. And that is what actually founders look at when they are also looking at angel investors. So you may be industry experts, you may have sectoral knowledge. More importantly, you may have some sort of time available to you, so that then you can, as an investor, angel investor, also commit and invest not only money, but time for these people. Now, initially, founders, please be aware of the fact that you cannot afford a lot of people, a lot of good talent at the early stage. But if you have mentors and advisors in the form of angel investors, I think you have got a fantastic white in that place. And the third white for the founders is very, very clear. They have a massive wealth creation opportunity. Now, there are only two ways to create wealth. Number one is to invest money. Number two is to become a founder of a company, which then raises funds. And then you have a lot of shares of that company and become successful. Then they raise funds later. And then you can obviously then offload some part of your equity to create wealth. And then you start investing as an investor yourself. Now, nobody has ever become rich and wealthy by saving money, by holding money with themselves. You have to keep investing, whether in good times or bad times. And that is how you can actually create a lot of wealth. So the first white that I talked about is for the founders. Yes, they get the wings to fly. They get external validation. They get good mentors, advisors in the form of angel investors and wealth creation opportunity. Every founder, when he starts, maybe does not take salary for 6 months to 1 year to 1.5 years. I have known founders not taking salaries for 3 years as well. But there are two sides of the coin. Sometimes it's a good idea, sometimes it's a bad idea, and really depends upon how much money in the bank is there of the startup or the company. But yes, they are looking at wealth creation opportunity. It's a great wealth creation opportunity for the founders. So these are the four whites that I typically talk about always, the advantages of being a founder and also getting investment. So because the topic is about investments and funding, that's why I have touched upon these points, the advantages to the founders. Because if I had only talked about investors, then it would have been not the best of the sessions to have, because we also want founders. There may be also founders in the audience, so they should also get advantage of that. Now, what happens to the investors? What are the whys for them? The biggest why obviously is that why are they investing money? They are investing money again for making more money, and then investing again and making more money. So it is a new age asset class which a lot of people have been staying away from because of obvious reasons that we know, and that we are going to be taking in the black, not in the white. But the biggest advantage is it's a great wealth creation tool. Now, when you compare traditional asset classes with this so-called new age asset class, I in fact call it as a subclass. I don't even call it as a new age asset class or a new asset class, because we have been investing in equity since time immemorial. So people are investing in the stock market. Obviously, this is just unlisted securities, and what we are typically talking about, the capital markets, are the listed securities, which are more tradable and things like that. Now, the traditional asset classes, if you see, are land, real estate, gold, fixed deposits, mutual funds, maybe paintings. It can be anything, right? So we all have been investing in all these traditional asset classes. All these traditional asset classes, they give you a median return of about 10%. And obviously, I have a thesis behind it, and there's a research that has been done taking into account the trends that are there from 2015 to about 2020. So fixed deposits in India, you see what kind of returns are you getting? What, 5.5%, 6%. Stock markets giving you returns of about 15-16% or 14-15% annually always. So that's a great asset class. Then you have gold, which keeps on increasing very steadily. Then you have real estate, which typically has been flat for some time, when I'm talking about 2015 to 2020. So these are asset classes that you have been investing. Now, honestly speaking, when I speak to a lot of investors, early stage ones, they say we are bored. It has become monotonous. How many houses, how much land, or how much gold do I actually keep gifting to my family members? And nobody sells gold. Nobody trades in gold. Indians love the yellow metal, and they keep it very close to their chest all the time. People may wear chains and bracelets, etc., but they will never sell gold unless and until there is a massive emergency in the house. So people generally, as investors, would not trade in gold. They only keep buying gold. Now, this kind of asset class, when it was introduced, startups, unlisted securities, people really loved it. The reason was that it can give you manifold returns. It can give you exponential returns, which none of these asset classes sometimes can give you, unless and until you are doing small caps and mid caps. If the corollary comes later, then I thought that it is better that I clear the air about small and mid caps, where yes, you can have multifold returns. Now with the small and medium exchange also coming in on BSE, NSE, which is the Bombay Stock Exchange and the National Stock Exchange, you can make a lot of money. But this asset class typically can give you returns as high as 20, 50, 100, 200x also. So angel investors who invested, say, initially in Ola, or they invested in Oyo, or they even invested in BharatPe at a point in time, made 50, 60, 80x, 100x, 200x also. And on our own platform, people who invested a small amount of, say, 5 lakhs, 10 lakhs, 5.5, 6 years ago, we have given them a 70x return, which is a 70 times of their money that they had invested. We have given back 5 lakhs becomes 3.5 crores and 10 lakhs becomes 7 crores. And some of them are still partially invested, which means that going forward, they may want to also offload later when the valuation kind of becomes much more, or it goes higher. So this is one typical asset class which gives you exponential returns. So that is a big white for me. And that is one of the reasons that we not only have our investors invest, but we also personally invest in a lot in startups. Between the 3 partners at our ventures, we invested in more than 120 odd companies. And in the fund also, all the 3 partners are LPs or limited partners or investors, as they say, because we don't want to miss out on opportunities that come our way, and we are not able to invest in those opportunities. Not that we don't invest in traditional asset classes, we do. But as I say, this is very critical. Now, people may ask, how much should I invest in startups when I begin my angel investing journey? I would say if you have 100 rupees, which is, or $100, which is investable money, you should start with maybe 10% of that. Just 10% you start with, and then you typically build a portfolio just like how you do in the stock market or the capital markets. You don't put all the eggs in the same basket. You build a portfolio of startups, and then you see the magic unfold. If you put money on only 1 or 2 startups, then you're spelling doom, you're inviting trouble. And for sure, if even one startup fails, then you will think that, oh, angel investing is not good and we should have invested somewhere else. This is not an asset class that I typically look forward to. So that is one of the biggest whites that we have in that case. Now, the second one that I can immediately talk about is that when founders get mentors, the mentors also love to advise and mentor such companies. Where do you get an opportunity to interact with such amazing founders who may be potential unicorn founders later on? So if you get into the journey with them very initially and during the formative stages or the growth stages of their business, and the advice that you give them reaps the benefits, not only in terms of the company going north, but also the money that you have invested also multiplies manifold, you feel happy about it. It's a feeling of achievement that maybe you have not founded that company, or you have not really gone ahead and spent a lot of time with that company, but that valuable advice of yours has been valued a lot by the founder and has benefited the business pretty decently, and you are one of the contributors of that company going really well, or that company becoming very successful. So mentor-mentee relationship is always a two-way traffic. It is never a one-way traffic, right? So if the mentor needs the mentee also needs mentors. I think that is something that everybody should be cognizant of. And if neither of the parties don't need each other or don't value each other, then that relationship will always be on a very sticky wicket. So I think the investors should be very happy that if they get an opportunity to mentor some of the startups, they should go ahead and do that. Maybe you are doing it 2-3 hours in a month is also sometimes more than enough, and the advice or valuable advice that you give them really benefits. So that's also advantageous to the mentor, because they also get to stay abreast and updated about the new developments in the business world, which they may not sometimes get an opportunity of doing when they are busy with their own routine work or business or job that they're typically doing. Now, there's also big white, as I always say, is that they're also getting to be a part of community of angel investors, like-minded people. I think during the pandemic, we typically figured out that we as human beings, we love to socialize, we love to interact, we love to talk to each other all the time. And today, I don't like doing Zoom sessions, but there are so many people across the world. But if I get an opportunity to do a face-to-face live session with people sitting in a room, I would love doing it. Because Zoom sessions and Google Meet sessions are not as effective as sometimes one-on-one face-to-face sessions. But yes, this is one of the best ways to reach as many people as possible. So community of fellow investors helps you not only share opportunities, insights, and knowledge with each other, but also builds friendships, etc. So you say the best organizations across the world, they have always thrived on the concept of fellowship and community. So we have a lot of investors who keep on talking to each other. And the best part is we have a lot of founders. We have about 125 founders on a single WhatsApp group, and they keep talking to each other. Sometimes somebody has some tech issues. Sometimes people want AWS credits, and unused ones are given to other founders. I think it's a great way to collaborate and make each other's business successful, and also collaborate and make each other's investments successful. So I may be getting an opportunity to invest in a company, and if I am part of an investment group or investors group, I can ask Vaibhav and Venu to join in, and sometimes or some other time they get an opportunity, they can always jump in and say, I think you should invest in this company because it's doing great. I'm invested. And when we say that, okay, my friends are invested, or people whom I know I can trust are invested, I think the confidence level obviously goes up. So that is one big white that we have when it comes to investing as angel investors or early stage investing. Now, when we talk about whites, obviously life is not just white, it is white and black. And as you can see My background also, it's white, it's black, it's gray. I mean, trust me, it's not deliberate. It was just designed that way and it has just happened. So let's talk about the blacks. Very, very critically, if you're raising funds from investors as founders, what are the blacks for you, or things that you should ideally be very cognizant of, that these are some things which are very, very risky. Now, first one, entrepreneurship itself is risky. It is one of the most adventurous things that you are doing in life, is to become an entrepreneur. Your enterprise may fail, and then you may have to go back to work, or you may have to start another enterprise. Now, if you figured out that I am using the word enterprise, that the enterprise is failing, so all the entrepreneurs here should give yourself a pat on the back, because enterprises fail, entrepreneurs never fail. There will always be advantages, positives, learnings from being an entrepreneur, right? So that is, I think, one of the things that I always say is that although it is one of the big blacks, is that you are taking a huge risk, but salute to all the entrepreneurs who have actually taken that risk and built great companies and great businesses. The other black sometimes, which we have also seen, is that they may not get the right set of investors. Okay, that is another black. So there are certain investors who want to really contribute a lot, but in that entire process, sometimes they just get over involved, and the entrepreneur does not get that freedom to function, operate the way they wish to do. Now, that is where he, or along with the investor, needs to draw a line saying that this is the black which is not acceptable to me. And I think I will come back to you, as we say, management by exception. I will seek helps, seek assistance when I need. But this is one black I don't want to get into, is that I get an investor who keeps on nagging me all the time, annoying me all the time by asking me questions, sometimes which are obviously relevant, but sometimes which may not be relevant to the business as well. So to the founders, I think you should be very, very wary of the fact that please be choosy of whom you are taking on your cap table. Now, this may seem a little pompous, and the investors may think that some founders are arrogant, but I think they also have the choice to select investors who should be on the cap table and who should not. Like how investors can get to decide in which startups to invest their hard-earned money or not, the investors should also do that. The founders should also do that. The second black which we have seen is that most of the founders, and this is also a research that has been done, is that cash flow management is a big, big black for some of the founders. So sometimes they don't know how to conserve cash, and that is where they typically get stuck over a period of time. So cash flow management is not just about being financially prudent, but also ensuring that you have the runway which is required to take your company to the next level. So do not wait for the last moment, as I say, right? If you have a runway of 6 months, fabulous, I think amazing, but you should always have at least a runway of 3 to 4 months before you actually get into fundraising. We prefer 6 months because sometimes the fundraising time can get extended because of factors which are completely beyond your control. So it's very, very critical that it is better that somebody's getting admitted to the hospital when they are feeling the symptoms, rather than going to the ICU with being on the ventilator or oxygen. I think if somebody has to really choose a situation or a scenario, people will generally say, okay, if I'm not feeling well, I will immediately do that. Not that when I faint, then they'll take me to the emergency room. No, that should not be the case in terms of the founders. So I think a big black that is there when you are doing entrepreneurship is that cash flow management becomes a very, very difficult task. It comes over a period of time. You don't need any professional or educational qualification to do it, but just ensure that you know your numbers pretty well. The third black that we have seen, which can happen in entrepreneurship, your next round of funding is not coming through, right? So that is, again, a very, very difficult situation to be in. And if you don't want to be in that situation, then, as I said, cash flow management / financial prudence is something that you should definitely take care of. So this is This is one black that I feel is there when you become an entrepreneur or a founder. So I talked about three things. We talked about the investor profile. We talked about cash flow management, and obviously the no future funding coming. I think that can really get dark for you, because you have invested so much time, money, energy, passion into building a company, but when future funding is not coming through, it may not be a very, very pleasant sight. So that's why it is said that this is one of the dark sides of becoming an entrepreneur. Now, sometime back, I was having a panel discussion at an angel investing a seminar, and they said that what according to you is also a dark side. And I immediately said that the dark side is that when you become an entrepreneur, sometimes your family or even friends don't support you. Now, typically in India, people say that you should take up a job, you should work, business, why are you doing? If what happens if the business fails, you'll have to get to the job again. And if you're not doing well in India, you may not even get married. Who is going to give a girl to you? All those things people generally hear. And hold behold, God forbids, if the business actually fails, it can get very, very demotivating and lonely at the top at that point in time. So that is a decent black that you should be aware of. As I said, the pluses and minuses are there, but you need to really decide which is the path to take. I always advise all the founders that whenever you get into entrepreneurship, you should be very, very careful about the fact that if you have a family, you should have enough money so the family has a comfortable life. Because it is very, very unfair that you have certain aspirations, dreams. They should not succumb to the results or not results of that particular company of yours or business not running. So in crude words, we always say, whenever you get into entrepreneurship, just ensure that your kitchen is running. I'm not saying that go on foreign holidays, etc., but at least you know that you have mouths to feed and you should continue doing that. So if you are planning to do that, get into entrepreneurship, keep aside money for at least 2 years time before you get into entrepreneurship. This obviously may not apply to younger people who are not having a family or not supporting a family. They can be as adventurous as possible. But yes, just ensure that you keep everybody happy, at least in the family, when you do that, and make them understand that why you're getting into entrepreneurship. Now, coming to the blacks for the investors. What is the biggest black that we have for the investors? The biggest black is the money that you have invested becomes zero. That's the biggest black for an investor, right? So if you have invested 25 lakhs in 5 startups and all the 5 startups fail, then that's a black. So how do you counter that? As I said, you counter that by building a portfolio and identifying companies with the help of angel investment networks like us or funds like us, who do 70-80% of your job, and then you do 20% of the job. You mitigate the risk, as I say, of investing into startups. Now, who should become an angel investor? People who don't really worry about the blacks should become the angel investor, the dark side of investing. If you're investing money, like I have a philosophy, if I've invested any kind of money, I think it is an expense. I am not expecting even $1 or 1 rupee to come back. It gives me peace of mind. And for that, you have to train your mind. It is not that I am giving Gyan, although the session is about the entrepreneurship Gyan, but I am telling you, this is the only way your mind has to be trained. That if I'm putting in X amount of money, it becomes zero. I'm not going to lose my sleep. My health is not going to get affected. My lifestyle is not getting affected. My family is not getting affected. And more importantly, you are not going to be calling the people who have helped invest, which means that if I've invested through our ventures, you are not going to call me and say, what happened? No, obviously you have the full right to do so. But till what extent do we generally go to ensure that the money is not lost is unimaginable. We open doors, we mentor those founders. We even go ahead and try and raise bridge rounds for them. We speak to existing investors so that they can be helped. We help them repivot. We do all those things. But even after all those efforts that everybody has made and we are not able to save the company, then I think that the company was not supposed to be doing good at that point in time at all. So during the pandemic, a lot of companies went southwards and they shut down. but that's the name of the game of angel investing. So it is definitely one of the riskiest asset classes you will be getting in. So as I said, if you're losing sleep and your health is getting affected by doing angel investing, do not do angel investing at all. Be ready to lose that money, and you will be a happier self, and you will attract more positivity, trust me, and you will definitely make money from angel investing. Now, the second black which we have seen is the FOMO trap, is the fear of missing out. Everybody is investing in startups. I also have to do it. And when you start doing it, you sometimes in a hurried fashion or in haste take decisions which may not be the best for your money. So when you start angel investing, start small, start slow, and don't fall into the trap of fear of missing out. Because as soon as you do that, you will continuously keep investing. Now, unfortunately, whether we like it or not, you may find people who may give you misleading recommendations, advice, or even opportunities, saying that you are definitely going to make money. We are guaranteeing you that you will make money in this business. Trust me, there is no guarantee to life. Therefore, there is no guarantee to even angel investing. Your money can become zero. Anybody who is giving you that kind of guarantee, I think you should definitely stay away from such people. Openly, I keep on saying in all my webinars, in my sessions, etc., that if you are ready to take the risk, then you should become an angel investor, or you should not. So don't get into that FOMO trap that I have to become an angel investor, and that's the only one of the ways I will become rich. I think that's one black you should definitely stay away from. So that is one dark side of angel investing. Now, the third one, I wouldn't call it as the dark side, but trading between the gray and the black. The reason is because the taxation I'm going to be talking about. The taxation in angel investing for investors is on the higher side in India. So you pay a 20% tax if you hold the securities for 2 years' time. If you do not hold it for more than 2 years, you exit before 2 years. It then gets added to your income and you are taxed at the highest rate that is applicable to your particular income slab. Which means that if you're already paying a 30, 35, 40% income tax, and if you are exiting before 2 years, then yes, you are going to be paying a lot of tax on the profits that you have made. Well, there is no harm if you make good profits, no harm in paying tax to the government. But an ideal scenario would have been that you hold the securities for 2 years, then you pay a 20% tax, okay, which is much lower than a 30, 35, 40% tax or the slabs that we are typically talking about. Now, as being in the investment fraternity, we have made representations to the authorities, to regulators, to Government of India as well, that unlisted securities should be treated as at par with listed securities, which means that your capital gains should only be 10%. The capital gains tax should only be 10%. So you'll have more and more people coming into the habit of angel investing and also investing more, right? And very critically, this has been examined and they're still thinking about it, okay, but no assurance because they obviously make a lot of money from capital gains as well. And the holding period also should be reduced from 2 years to about 1 year time, just like how we have in the listed securities. So in the listed securities, whatever share market you're investing, you hold the securities for 1 year, 12 months. And when you sell after 1 year, you are taxed at 10% capital gains, which is fabulous. So we are doing that. So that is one of the dark sides also of angel investing, is a higher tax incidence. If you want to consider it as one of the blacks, for me, if I'm making money, I don't mind paying tax. If I am making more money and early money in less than 2 years' time, let us pay tax and we sleep in peace. That is very, very important. Whenever there is white, whenever there is black, there has to be grays in life, right? So whether it is your hair as well. So let's start with what are the grays for the founders. Number one, founders find that these legal terminology, term sheets, shareholders agreements, whatever is written, they sometimes don't really understand. They think that they're gray for the founders. Maybe over a period of time, they learn how the shareholders agreement, etc., or the legal agreements are in their favor. But unfortunately, if you don't have good legal guys by your side, legal folks by your side, then that can actually become a gray area as well. So you need to really learn the tricks of the trade and have clauses which are not only beneficial to the investor but to the founders as well. So what we do here at our ventures, we have a very balanced shareholders agreement. We protect the money of the investors, but also just ensure that the founders are not really squeezed so much that they lose all kind of motivation in running their business, and the entire effort of returning your capital with returns is then gone into thin air. I think that is something that we don't want to do, and that is why we say that no point in getting into legal tangles, as we say, whether it is shareholders agreement or later on if the company does not do well and it shuts down, is something that is definitely a big gray for all the founders that are doing typical business. The second gray, which is there is, and that's also research, is the co-founder issues. I have a co-founder. After some time, both of us are not in sync with the vision, the ethos that we personally have. Maybe our personal attributes are now not matching, or something has gone wrong. That is one big gray area that is still there when people are doing business. And some investors, they don't like investing in single founder companies. They want to invest in co-founder companies, because then the risk is also mitigated a lot. So if there are 2 founders, 3 founders, and God forbid that something happens to one of the founders, then at least the 2 other people can continue with the business and the money is not lost. But if the single founder company and something happens to the founder, unless and until that founder has built a fabulous tier 1 team, a top layer team, then it becomes very difficult for the business to survive. And that is why we say that for the investors also, this is one of the gray areas that they should be looking at by taking keyman insurance, etc., at least during the growth stage business. And that actually is also being done, that if something happens to the founders, the insurance is of that value that it covers the investment of the investors. I think that is something that investors should look at when they are investing in growth stage companies. I have not seen a lot of keyman insurances taken for early stage investments, but yes, for growth stage investments or companies which are getting investment by micro VCs, this is a very, very critical component that everybody should look into. Another gray that is there, and it is, I think it's a phenomena that is very, very close to India, are the compliances. Founders sometimes do not understand compliances. The intent is not bad, but there are so many compliances, which one to do, which one not to do, what is the priority, and if sometimes they don't have the knowledge, the money, and the access to resources, that it becomes a gray area. And that comes up in the due diligence, when the due diligence actually happens and things really then are not so good. So having a good compliance team after at least the first round of funding is very, very critical. So that is for sure a gray area, and compliances are a gray area because new compliances can be added at will by the government authorities. And if you are not aware of that, it becomes a problem of sorts. And when it comes to compliances, obviously the taxation also is there. Sometimes there is angel tax. Sometimes there is no angel tax. You take a certificate, then there is no angel tax. You sometimes have to give a valuation report, then there is no angel tax. Now, angel tax also, in a way, was always a gray area. In fact, today also some of the companies are getting notices from the income tax department for angel tax. Now, luckily, who are insulated from the angel tax processes at this point in time are the investors. So the investors need not worry. The notices are coming to the company and they may have to tackle it. But if they've kept their books clear and clean, they have taken the startup registration certificate, then I think the new diktat is very clear, is that you do not have to bother these startups and they can go ahead and be free from the problems of being bothered. If I may say, I don't want to say harassed by the authorities, but don't get bothered by getting such notices. Just ensure that they are replied to. So that is why I call it a gray area, because they sometimes do not know notice has come. It is lying somewhere in their closet or in the drawer, and they've forgotten, and then it becomes a problem. So let us, as founders, ensure that you reply to each and every government notices that comes your way. It will no longer remain gray. It will turn into white, and you will be doing business in a more hassle-free fashion. What happens? What is the grays in terms of the investors? I think the biggest gray, I always say, is access to quality deals or access to quality startups. Sometimes it becomes so difficult to evaluate which is a good startup, which is not a good startup from an investment perspective. I respect all entrepreneurs and all companies. That's why I'm not saying that no startup is good. They all had great intentions to start a startup, and they wanted to build a product, a company which is world class. But yes, you as an investor need to decide which company to invest in when it comes to early stage investment. And that is one big gray, trust me. And that is again where, people like us who've invested and we run a network and a fund will help you to shortlist such companies. You can go ahead and do that. Now, as there was co-founder issues, now the investors may also face issues with founders or promoters. One co-founder left, the other co-founder is now depressed. Now, what do you do as an investor? Because now it feels that he has no longer interest in the business. Then what happens? And as I said, that we definitely, as being there, will intervene, but investors also sometimes have to come together, and some of the investors may be board observers, they may be on the board, etc. Some influence will have to be made on these founders to ensure that the business keeps running and it reaches a level where the investors can get their money back. Forget about the returns. At least you'll get your capital back and you'll be happy about it, that $10,000 has not become zero that you have typically invested in a business. Founder issues, promoter issues are fine when it is amongst themselves. But what really happens, why I call it a gray, that the founder decides, I no longer want to run this business. It is time for self-actualization. I want to go to the Himalayas and I want to really now forget all material things in life. I am on my way to attain nirvana. What happens in that case? That is the mechanism that we also have in our agreements, is that if after 1 or 2 years the founder thinks he does not want to continue with the business, we have vesting of securities or shares at that point in time. So even in early stage investments, we ensure that we have the vesting. What is vesting? The shares of the promoters are not with them till about 4 years time, which means that they have solid 4 years to get their entire equity, which they can then put on the block for selling later on. But if that is not happening, then that equity is not vested with them for that particular time, and that it stays in the company, and obviously investors will have access to that equity. There are a lot of nitty-gritties around the same, but yes, what I'm trying to mention here is that the grays are there when it comes to promoters and founders. If they want to leave the company, what happens to the investors' money? Well, if you have the documentation there properly done, it turns into white. Then it does not remain a gray at all. So I think the investors, like the founders, should also be aware of their rights, their duties, their responsibilities, and more importantly, what is the recourse that they have. Those are all built into the agreements. Now, there are a lot of people who may say, when the agreements come out of the closet, I think the company is going to shut down. Nothing happens. No, that's not the case. Sometimes the recourse really helps. At least you can control the company, and collectively, sometimes you can even go ahead and ask a senior team member from that same company to run the business to ensure that your capital comes back. And the last gray is for the investors also is sometimes compliance / regulation. Especially people who are abroad always think that India is a difficult country. There are a lot of compliances, regulations, and sometimes not clean. So it is definitely a gray area. Now, things are becoming better. I wouldn't say that they are the best. It can become better. Whenever money has to be taken out of India, you have to pay a withholding tax here, the credit of which you can take in your home country if you're not in India. India, it is not a problem at all. It reflects in your income tax records, and you automatically get that credit of the tax deducted at source, or the withholding tax, as we call it abroad. But yes, not having enough knowledge about these things can be a gray area for the investors as well. So whenever you're investing, be sure of the fact that you are aware of the compliances that you are supposed to do from your end. And obviously we help you with that, with all the paperwork, etc. And more importantly, about the taxation effect that is going to happen. Now, as I said, taxation is becoming better and it will continue to do so in the times to come. So I spoke about the blacks, the whites, the grays of angel investing from the founder's perspective and from the investor's perspective. And I think we are now at about 21, 22 Indian Standard Time. So we have about 10, 15 minutes for question, Vaibhav. Is that okay?
Yeah, that is all right. Yeah.
Perfectly. So opening the forum for questions. Is somebody going to be moderating it? Venu, will you moderate?
Yeah. We didn't ask a question. Normally, the audience they'll put in chat. Yeah.
Awesome. Go ahead. Yeah.
So I think first off, Amitji, there's a lot of details. I know personally I was able to connect to a lot of it because of some of the experience that I worked on back in the roles that I handled at Goldman Sachs. We literally have entities which invest in AIFs. So they're based in Singapore and Mauritius. So we've done some of those. I understand those challenges that you mentioned, but I think a lot of people are curious, even among the audience, or as a startup founder, a lot of people want to get funded. So when they reach out to say our ventures for funding, and you definitely have you have what 60,000 plus different entrepreneurs who are interested in getting funding, and then the number of people who are investing into it are also scattered. How do you sort of build that fund? Like how do you build a fund to enable that that funding to actually get scattered into these businesses? Like, can you share some of those details that happen behind the scenes?
So what really happens, I think we evaluate close to about 300 plus businesses every month. And there is a deal sourcing team. It goes through a 4 level of curation process. One, when the deal sourcing team gets it, they have their own set of checklists that it goes through. Then second, it comes to the partners, and one of the 3 partners evaluates it and ensures that it is meeting the so-called criteria that we have listed down. Personally and professionally, I think I typically follow the 3P principle when it comes to investing. Number one is the people behind the scenes, okay, behind the startup. So 50% weightage I give to that, right? Because early stage investing is only about the founders and the problem that they're trying to solve or the product that they typically have. The second one is product, which is 30%, and then the potential is about 20%. So the three Ps that we typically have. Now, within the 3 Ps, you'll have a lot of other checklist criteria that will be listed. And I think if it goes through that, nothing like it. Then we have an internal due diligence also. I talked about due diligence, which is external, but internal due diligence also happens to ensure that the founders, the team actually exist, that businesses actually exist. We do a business model, a due diligence also to ensure that whatever is there, the market will be ready to absorb or not. Now, I can't do everything because this is early stage investing, and what will click in the future is never guaranteed. So whenever we have our check boxes done, I think we've done a pretty decent job. Out of the 125 startups, luckily only 16 have shut down. So the percentage is pretty good. So that's why I'm mighty proud of the curation process. So all the startups that we're talking about, more than 100 of them are still alive and kicking. 16 exits till date, IRRs ranging from 30 to 90%. I think the curation process really helps. And once the commitments come from the investors, we then also have an external due diligence by external chartered accountancy firm and legal firms to ensure that at least the basic compliances and the hygiene checks are in place to ensure that the investor's money is safe. Whether an investor invests honestly 10 rupees or 10 lakh rupees, I think that's their money. Nobody can really say, oh, that's only 10 rupees. How does it matter? If it shuts down. No, that's not the case. The 10 rupees may have a great value for somebody and 10 lakhs may not have any value for somebody. So that is a possibility. So that is how we work in the background. And then after the due diligence, the shareholders agreement, etc. We have standardized the entire format to ensure that the deal gets done faster. And as I said, the clauses are such which are beneficial not only to the investors but to the founders as well. And I'll give an example. Founders, if there is a buyback that ever happens, we never have a clause which says that the founders have to buy back the securities if no exit happens over a period of 4 to 5 years. Where will the founder get the money from, right? To buy back the shares. So the company has to buy back. So that is how these are some of the mechanisms we have kept. And they're all sometimes open to negotiations when you are in the growth stage, but not in the early stages. I think we have pretty much standardized the agreements to that sort. And then the money is wired into the startup's account. And I think that is how it typically works. That's what happens in the background. A lot of work happens in operations. It all looks nice when it comes to angel investing. The money has come in, but yeah, there's a complete machinery behind the scenes.
Very interesting to know.
All right, I see there is a question from Ankur.
Yeah.
So so he's asking that there are sectors like space, EV, deep tech are getting more funding than others. And does this mean other sectors, especially something like edtech or skill development, are at a disadvantage? So what is the suggestion to an aspiring edtech entrepreneurs? Also, this is an interesting question for me as well, because being a faculty and being a professor, working in a similar space, I do also, I do have a small startup as well, which is, on this particular front. And just now, as mentioning, I'm coming from a convocation of a friend. So yeah, it's in that direction. Yeah. Yeah,
absolutely. No, I think it's an interesting question, and I'm going to be answering it from two angles: from typically how investors think and behave to begin with, and what is happening to the sector. That's the second way of looking at things. Now, investing, whether we like it or not, is very sentiment driven. We need to understand that. Even the capital markets are the same. So if the sentiments globally are not good, then people will not invest. And if sentiments are driven by fact that there's certain edtech companies not doing very well, whether in business, whether compliance wise, then the confidence of the investors is definitely going down. So I was in Lisbon at the Web Summit, which is one of the largest investor summits of the world. About 70,000 people come together and they discuss about investments and what's the outlook for 2024, how 2023 has been. I think there's a lot of emphasis being now laid on governance as such. And they have been hearing horror stories about how some of the edtech companies in India have not done well because of whatever reasons. And that's why they are not investing in India at this point in time when it comes to the edtech sector. Now, what happened from a sector perspective also, when the pandemic hit, people who were only doing online really thought that they will thrive by doing only online. I think that was one of the biggest fallacies of any business model, is that we will only do good online. Having said that, today, if we look at the edtech sector, everybody is now trying to do hybrid. And that's why that repivot is happening. People are trying to do a lot of things in the edtech sector. Now, money is limited. As Ankur has asked the question, money is limited. They will now invest in sectors which are so-called sunshine sectors. And where the innovation is happening, things are moving really fast. And it seems like it is a long-term phenomena, to be honest with you. And edtech during the 19, 20, 21, it looked like it's going to be a long-term phenomena. But as soon as the pandemic got over, everybody wanted, as I said, to go back to their physical classes. And that is where the problems have actually started to also happen. That monetization has become a problem. Second, having your customers to stay with you has become a problem. Because as I said, we are human beings. Our mindsets are going to change over a period of time. So this is something that we are definitely looking at. And our ventures has got exposure to more than 20 edtech companies, by the way. So we have invested pretty decently. Having said that, are we going to invest in edtech going forward, or how is the outlook looking in 2024, or what an aspiring edtech entrepreneur should be doing? I think very clearly, if there is a solid business model which demonstrates a specific USP, if you're going to be part of the crowd, it's going to be really, really difficult to get funding. Second, I think if you are doing something which is different is fine, but also in a profitable way right from day one is something people will be looking at. Right? And don't just rely on something which is completely online. It is going to be extremely difficult to sustain over a period of time. So that is my advice to an edtech founder who wants to be, say, in 2024. But yes, I will want to look at all edtech founders, because we believe that education in India is still at a stage wherein it needs a lot of improvement, and lot of innovation can go not only in the delivery of the education material or the content, but even the content that needs to be developed.
Amitji, I know we're sort of 2 minutes over the time mark, but would you be fine if we extend by another 5 minutes? We have a couple of
Absolutely.
questions.
5 minutes, 10 minutes, not a problem. I also have a direct question. I mean, he's sent it directly to me. Is it okay if I just read it out so that people know?
Yeah, sure. Please go ahead. Yeah.
So what do you think is the minimum amount to start investing? Well, it really depends. But as I said, that if you come to our platform, minimum is 2.5 lakhs per investment. That is what we typically do. But there may be other opportunities where you want to invest only 1 lakh of rupees, or if you want to divide it by 80 to get the dollars, you'll typically get it, or 85. So there is no set amount that is there for investing. But please understand that the lesser you invest, when the multiple is even higher, it's no fun. So invest 5 lakhs, you get 5x is 25 lakhs. But if you have 20 lakhs to invest, you get 1 crore rupees. So I think it's a game of multiples. But I would be safe to say that if you want to start investing in India, about 2.5 lakh rupees per startup is a good starting point. Yeah, go ahead, Venu.
Great. So I'm going to combine just 2-3 questions into one, which have a similar theme. So
Yeah.
one we've seen is, do you invest in startups which take, say, a longer duration to develop? Say if they take 2 to 3 years to develop, do they, do people invest in such startups?
Yeah.
As well as, what about investing in medical devices or core technology? Basically, how long do, investors wait, or what's their sort of comfort period with investing, and how's the situation in AI looking as of now, and say the future that you predict it to be?
Perfect. So I think there are 3 questions together. So one, that deep tech technology, which takes about 2 to 3 years, we don't do that because we need traction. So we are not the right investors to get into that. But the first gear program that we typically run is for some startups which are just probably developing the product. And if it's something which seems like a rock star one, we may definitely have a look at it. It's not a complete no, but if you ask me what has been the trend or how we generally invest, we don't generally invest in companies where the product is not ready. But there are a lot of angel investors who have that knowledge about that particular domain, or they have expertise in that particular domain. They invest in such startups because they know that if the product comes out, it's going to be a winner, right? So there are investors, and there are also VC firms who actually do that. They invest money. Now, to those startups, if they are not able to get money from such sources, the government of India has got n number of grants for deep tech companies into space tech, robotics, artificial intelligence. When artificial intelligence for me is a horizontal, it is not a vertical. So that is very, very critical to note. And that is also helping me answer the third part of the question, is that what is the future looking like? AI is everywhere. AI is not a vertical, right? If you say whether it's automobiles, whether it's heavy industries, whether it is anything that you are doing on blockchain, AI is everywhere. You will need AI everywhere. So it's going to be very, very stupid to say that no, AI is not going to be the future. It is going to be the future. We are seeing it, but it's going to be across industries. So yes, if people are only thinking about saying that we are going to be investing in core AI, well, core AI is something very different than AI being present in a lot of sectors. So yes, people are going to be taking bets on that, and that will continue to happen for sure. Some of that is going to reap benefits which is not immediate, which is year 5 to 10. That is the horizon that everybody is looking at, because it's a new phenomena. It's going to take time to really give the benefits to or the results to everyone else. The second part of the question was about health tech devices. Now, there is a massive upsurge of people who are now going to be inventing or getting into inventions of healthcare devices. We have invested in at least 2 to 3 of them. I can immediately think of. One is a medical device which ascertains your stress levels by putting in a cap like a thing, right? It's called Neophony. And it also then gives solutions to reduce the stress, whether it is some kind of music playing, etc., etc. So that is, and they have put at places, they're put at corporates, they're kind of pods that then go lie down and then help you relax, etc. The second, we have invested in a company called Punar, which has made a health tech device. It's a robotic hand, which now helps in physiotherapy. So what really happens, physiotherapists, when they do physiotherapy for every patient, they sometimes may not remember what kind of physiotherapy that needs to be given, what kind of pressure and where the pressure needs to be put. But if there is a robotic hand that they're wearing and it is controlled by say a device and a software which has the data also that this is session 3 and this is the intensity with which it needs to be done, then the physiotherapy will happen that way. And a lot of data also is being captured to ensure that things become better. And this is for even very bad and chronic cases or injuries, which sometimes require super specialization to do physiotherapy. So the machine over a period of time will keep learning. So there is a lot of AI ML again also being built into the entire protocol of things. So yes, we do invest in healthcare / medtech devices, and we will continue to do so because we think there is massive future. Now, whether the acceptability of those medical devices is going to be there or not is to be seen. But any investor, I feel, should support the future of at least healthcare, if not anything else. Because what happened in the pandemic was a very bad mirror that was shown to us. And we knew what the healthcare facilities of India or the infrastructure is. We need to really up the ante to ensure that startups now come forward and ensure that the healthcare infrastructure and the healthcare system of the country is improved, not only in the urban areas, but the semi-rural and the rural areas as well. Yeah, so we are very, very bullish on the devices market.
Got it, Amit. And I think just there are two other questions. Again, I'll try to combine those in broader themes. I think the people are interested in understanding the interest of investors in sustainability sector, particularly sustainable farming, and the scope of, say, cosmetic industry and its growth opportunities.
Awesome. So for both, I think everybody's bullish. You have seen how the investments are coming through, not only in the agri-tech sector, but also in the beauty segment, in the D2C sector when it comes to personal care and hygiene and beauty. In fact, behemoths like Unilever, etc., now they have started actively becoming investors in some of these companies, not only helping them with investments, but also developing products with them, etc. One of our portfolio companies, they are building a new set of product, which is in the nutraceutical space with Nestle. So that itself is amazing because you're getting a validation from such a big, large company, which has been in the nutraceutical or in the wellness space, then they can go places. So yes, not only investors, but corporates. Now they've started their own venture arms to invest in these companies. And there is a reason to it. Innovation in the D2C sector, when it comes to beauty, wellness, healthcare, nutraceutical, it happens because one, the startups are agile, not only in thinking, but also in their execution. Now, if a large FMCG company needs to launch a new product, it cannot do so in less than 1 year's time or maybe 18 months' time, because it needs to go through a lot of processes, testing, approvals internally, etc. But if a startup has to do it, it can do it in 2 months. Now, they may launch 10 products where 5 may fail, 5 may do well, but maybe some of them are doing so well that tomorrow an FMCG company will come and just scoop you. So that is a big thing that people are looking at, and not only in terms of innovation, in developing a product, but also launching in the market and executing the entire business plan. So yes, very bullish on the cosmetic industry. It is growing and will continue to grow, not only for women, but as for the men as well, because men are also now getting very, very conscious about the way they look and how they should keep their skins alive and kicking all the time. Everybody wants to look young and feel young. So you look young, you feel young. I know that's the mantra. I think that's what people are now understanding. Coming to the agri-tech space, again, just like education, just like healthcare, agriculture is something that is very, very critical to our country. And if we can, one, make the lives of the farmers easy and we can get better products from them to us, which is more healthier, then I think it's great. I think why not? If the cost of production comes down, more production happens. It is great. A friend of mine, who's by my batchmate from school, suddenly has become a farmer, and he's doing only organic, taken about 6.5 acres of land and cultivating a lot of things, not only for himself, but also now he's starting to sell. He's got 6 cows. He's got so many things coming up, whether it's onion, whether it's paddy, whether it is turmeric. He's doing a lot of things. So I think more and more people getting into it is great for the ecosystem. And he's using certain technologies for doing things where he's not using a tractor. I was shocked. He's using small stuff that is there, which is now tilling on its own, which is the best thing. So you don't need tractors or a driver to do that. You just set the geographical parameters and they will do tilling on their own. So yeah, a lot of things happening. Very, very bullish on the agri-tech sector as well.
In regenerative farming, tractors are actually, destroying the soil. That's what regenerative farming, we call about. So they prefer using, those other traditional methods of farming.
Yeah.
Cool.
All right. I know we'll keep getting a swarm of questions as we go through, Amitji, but we also want to, keep a sort of end to it. And some of these questions, I think folks can directly reach out to you, or, they can reach out via the Ventures website itself.
Yeah.
So we'll probably leave it at that. And I think the session was fantastic, a great way for us to wrap up the TEG sessions for the year, and it was quite insightful to listen to some of these details on how does somebody think in the white, in the black, in the gray phase. What are the considerations that go in? Because I think a lot of people, when they think of a startup, they think of the whites. They're very enthusiastic about it. As an investor as well, a lot of people look at it, oh yes, 5x, 10x. But I think the key point there being you have to have a level of comfort and a risk threshold, which as you mentioned, somewhere around say 10% of your corpus, so that you don't end up losing all of it. At the same time, you end up generating a great upside by diversifying your investments. I think a lot of the food for thought for people who are interested both in the startup as a founder as well as an investor. So I think that is definitely a fantastic knowledge reaping session for a lot of us, and a lot of food for thought for us. So I think thank you for that. What I'll do is I'll pass on now to Vaibhav to sort of give the closing vote of thanks so that we can end the session here. Over to you, Vaibhav.
Thank you, Venu, and thanks a lot, Amit, for your time, for your precious time. And I think it was a really insightful session. And we wanted to end this TEG sessions of the year of something of this sort, because I have been waiting to bring someone from the VC world, and it was really interesting because it made a lot of sense to and seeing the questions, I can understand people really got interested in what you had to say about the topic. So thanks a lot for your time, and happy 2024 to you and to everyone. That's what I would love to say.
Perfect. Thank you, Vaibhav. Right. Thank you, Venu, and I look forward to meeting you folks soon sometime.
Yeah. Okay.
Absolutely.
Yeah.
See you.
Bye.